Thank you for the generous introduction. So, one thing I wanted to talk about, one morning Rajiv said that Subra, who's my friend because he was my colleague also, said in 2005, there was only one person who was in the same place, but I have also been working in ICICI Mutual Fund from 2005. So I sent a WhatsApp to Subra and corrected him. So that was the thing. So generously, CFA Institute has given me an afternoon slot. So I must talk about my experiences in Japan. So in 2015, I made 5 visits to Japan. And there was one thing which used to be very interesting is, in India, no, if I have to do a meeting with IFAs or wealth managers or even customers, you do evening meetings. But in Japan, I went for 1 full week, and every afternoon I would have a meeting around lunchtime. And the first and most interesting thing about that meeting is, suppose the meeting was to start at 2 p.m., they would make me stand at 1:58, and everyone would be in their seats. There won't be anyone with phones not on silent. And for 2 minutes, I would have to wait till the clock touched 2 o'clock to start. And for us in India, how could we have done it if everyone has come and you're at 1:58, you will start it. But here you have to wait for that 2 minutes. That was just unbelievable for any Indian, particularly any event in Delhi, or it's very, very unthinkable. The second interesting thing which I saw with all my meetings was the weighted average age of the person who was attending the meeting was between 70 and 90. So on the second day evening, I talked to one person and asked that person, what is this? That all the people I am meeting in this afternoon meeting is 70 to 90, and they all have Japanese interpreter. So that person told me that all of them are the richest people in Japan. So that was very interesting to see. And next day, I was talking to someone about zero and negative interest rates in Japan. And that person knew English well, said, one thing you should remember in Japan is that every year we have to break down houses because the number of people are going down. And every year we have to close down a few schools because population is going down. And what I learned from that entire event was, if you have entire economic theory that has been created over the last 200 years was built for populations rising. But if you're going to have a population declining, there is no economic theories which are available at this point of time. So as long as Japan has current account surplus and populations are declining, I don't think interest rates are going significantly higher at all in Japan. So they'll remain zero. Because every year you don't need investment, you need disinvestment in the form of breaking down houses, breaking down schools, etc., etc. And this was why big learning from my Japanese visit. So I thought I'll talk about my investing career. And my goal is not to give all the answers. My goal is to sometimes create the questions. So this was a very interesting thing which one of the books I read talked about, that investing is about 3 things: buying, sizing, and selling. And the irony is that if you look at the investment literature, 98% of the investment literature which exists in India or in the world is on buying. And less than 2% is focused on sizing and selling. And frankly, I don't have all the answers on sizing and selling, but I certainly know that if you want to size your position, you should know how much to size based on your conviction, the upside you see, the risk you associate with that investment, and the kind of detailed work that you have made on that company. And in my reading, most people in investing, they all make a sizing mistake. And sizing, I am yet to get enough literature. As far as selling is concerned, it's again something where very little work I have seen. But there's a friend of mine in Chennai who taught me that just remove the word selling. He said, think of it as a switching. So he said that every selling decision that you are making, think of it as a switching decision. And then evaluate the switch. So if you're selling some 50 shares of TI and buying 100 shares of Sundaram Fastener, evaluate that switch. Don't worry about whether you are selling tube investment at the right time. You think of the switch. And the moment he told me that, after that, whenever I am confused on whether to sell or not to sell, it's a very, very simple decision you have to ask yourself. Look at the counterparty of the transaction. Do you like the counterparty of the transaction? If you like the buying, don't worry about the selling. You may go wrong on the selling, maybe it will go up. But why do you worry about it? You evaluate it as a switch. And in my reading, if every investor spends little less time on buying and a little bit more time on sizing and selling or sizing and switching, I think the investment returns for that investor should be much better. So one of the things I have gotten used to is that people have associated me with contrarian approach to investing. And why did that happen? In my opinion, it happened because when you work for a mutual fund, like I say mutual fund, you will get a lot of money. And there is absolutely no choice to that. And when I sat in that job, I realized in 2007-8 that the moment you become contrarian, frankly, you don't need to worry about money. Flows will come always at the wrong time, and you'll have to find a way to manage it. And that is how I actually decided that maybe I should become a contrarian. And in my opinion, contrarian is the easiest way to actually invest scale. So if I had 10 lakh rupees, I don't need to be maybe a contrarian. But what I realized about this whole contrarian issue is immediately people thought I'm going to buy some junk infrastructure stock. The reality is that you can't buy junk just because it is contra. And the best lesson I learned was in 2008, I used to be running Discovery, and at that point of time, there were a lot of value funds which went belly up. And there were a lot of value funds which actually did very well. And there was a very famous Bill Miller interview. Bill Miller said, and he was such a famous fund manager of Legg Mason Value Fund. He said, one of the mistakes I made was that I put 38% of my portfolio in financials. And the financial stocks that I had leverage of 20, 30, 40 times. And then they blew up. So I realized that one of the key things you have to keep in mind when you are pursuing a contrarian approach is that you have to be very, very careful in leverage stocks. And the moment you are very careful in leverage stocks, frankly, I think one of the worst investments through the contrarian route goes away. So what do I find very useful is in cyclicals, because at the end of the day, there you find that the cycles help you to buy, the cycles help you to sell. And so inadvertently, if you ask me, I started to look very, very deeply into cyclicals, because in cyclicals, you don't suffer from the entire problem of leverage. Having said that, I think it is very important for a contrarian to know what is the other side of the trade, why is the other side selling, And you have to make some calls on that, and you have to have a very good assessment of intrinsic value or risk. Frankly, if you don't have the ability to do risk management, I think contrarian is not the style for you, because you're buying against others. So if you don't follow risk management, frankly, it becomes a serious problem. What are the other things I clearly believe in, if you ask me? Clearly, I believe in the fact that, and I didn't know how to put it, but my guru Howard Marks taught me this whole concept of cycles. And once you realize that everything is a cycle and everything is like that old-fashioned clock which moves from one side to another, you're in a superb position to actually look at cycles. And I've seen that cycles come all the time. And at one end of the spectrum, you'll find it very, very careful. You have to be very, very careful. At another end of the spectrum, you have to be reasonably aggressive. So if you look at the last 6 months, we have spent a lot of time looking at the cycle, and actually we found that credit is the cycle which was showing extreme pessimism. And we did try our best to explain to people that credit was so cheap because the cycle was so advanced, because every day people were worried about credit. And in our opinion, clearly if you look at it, that is the most important part of long-term investing, is the ability to look at cycles. And remember, it is not arithmetic. You will never get 100% clarity. You will never know what is the top. You'll never know what is the bottom. And but at the same time, you'll have a good, reasonable judgment. Like today, if you look at equity markets, you know you're somewhere in between. It's very obvious. And I got the chance to read Anthony Bolton. And Anthony Bolton told something in his book which was very important. He said, please look at the chart before buying, and please look at the chart before selling. And many of my colleagues in my department still don't realize that it is so important to look at the chart, because once you look at a chart, you know how many other people are in the same camp as you are. And when you look at the chart, you know how many people are not in the same camp as you are. Somehow many fundamentalist fund managers think, what is all this chart? I don't use it to design breakouts, breakdowns, support level, resistance level. But what do I use chart for? Only to know how many other people are thinking like you. That's all. So I'm not using any parameter which some of the chartists go. Like as most of you know, in Bombay, the popular joke is all the chartists live beyond Andheri, because they lost money in some end point of some cycle because the chart told breakout and it broke down. So, but I believe that as an investor having to deploy large sums of money, charts become so beautiful. So you take any stock, take an example, this is published information last month, for example, Infosys crashed. So in a special situation kind of fund, it becomes so easy to look at the chart and say, it is just telling you it's a special situation and you have to buy it. So I believe that if investors spend that 1 minute looking at a chart, and today it's been democratized. There was a time to get a chart was difficult. Today, thanks to Bloomberg and various, if you have Apple phone, the entire chart is available. So easy, but I would tell you to use it. The third is common sense. Common sense is easy in retrospect. So in 2018 January, my CEO decided to return small cap money in the PMS department. At that point of time, it didn't look like common sense. People were so scared. But today, if you go back and ask yourself, small caps were so costly in January 2018. Was it not logical that you should take out money from small cap? The answer is yes. In 2013, if you had looked at real estate in all parts of India except maybe Hyderabad, the chart of share of the prices of real estate was telling you that it was very, very clear that you had to sell real estate. But somehow, at that point of time, common sense appears difficult. But when you look at any event in retrospect, like you go and evaluate Warren Buffett's 2008 decision to invest in preference shares of Goldman and GE, and 2011 decision to invest in preference shares of Bankcam, in retrospect, it looks so sitter at this point of time. But on that day, somehow to evaluate that as common sense becomes much more difficult. So there's an important lesson that I learned from my fund management career from 2007 to 2009, which was that money came at top in 2007. No money came in 2008. We were just answering questions. Market went up in 2009. So we asked ourselves as an asset management company, what would we do different? And we came to what Warren Buffett says is the most important thing, the ability to have cash. So the moment we decided that actually we will have a strategy which will have cash called balanced advantage as a category, and we have seen that cash improves the quality of decision making significantly, because if you take the balanced advantage fund as a category, last year we got a chance to deploy 6,000 crores in September and October. This year we got a chance to deploy 6,000 crores in July, August, September. And in my reading, the ability to have cash at the right time is the most important requirement to make big money. Why is it in 2008 October Warren Buffett could invest when others couldn't? Was because he had cash. And why could Howard Marks invest in a special situation? Because he had collected a fund in 2007 and left it undeployed. So I believe the role of cash in long-term investing returns, particularly in a country like India, is severely understated. And my experience is that it is a sitter that one should always have cash. You don't need to have cash at the bottom, but you need to have cash at the top of the market. And like if Nifty is 12,000, if you have cash, you'll never go wrong. That's what we have realized over a period of time. So people will ask me, how can you make a talk without talking about stock picking? One of the reasons I'm talking less about stock picking is that the style that I have today, and I think Prashant also talked about it, many of the simple metrics that I use, which is trailing price to earnings, trailing price to book, market cap, balance sheet quality, all these things, of course, the balance sheet quality of the quality companies are fantastic. But what I have seen is at this point of time, if you had ignored trailing PE and used only PE to buy, every year, the PE of consumer companies have also gone up. So the style at this point of time has not been working. But in my learning, in 1999, as Prashant also pointed out, the style would have looked foolish, but finally the trailing PE worked. In 2007, trailing PE worked. So I have seen that at this point of time, it does look that trailing PE, dividend yield, trailing price to book, all the market cap, all these things don't look like working. But when you have longer investing cycles, frankly, it actually works very, very well. And but if I had to look for one indicator, which I have found to be very useful, it is actually market cap. And when I use market cap in extremes, it has actually worked for me phenomenally well. So in 1999, each, that is Infosys and Wipro, had a market cap higher than the market cap of the entire cement and metal sector. And when you see this one company having market caps equal to the rest of almost big sectors, frankly, in the whole selling argument, you may still be wrong, but eventually you will be right, because you might miss the last rally, but it's okay, because you're getting entire sectors for the market cap of a single company. This happened in 1999. I was looking for data for 1992. I couldn't get it. But I remember that all the Harshad Mehta stocks, ACC, Apollo Tyre, Mazda Leasing, all of them had absurd market caps relative to the market. So I believe that market cap is one of the best indicators which works at extremes. You don't need to use it every day. But once everyone starts talking that this alone is working and this is not working, go and look at the market caps. So if you look at a similar case in 2007, today it looks very, very simple as common sense that DLF can't have a market cap higher than the entire pharma sector. But the reality is DLF market cap was 1,83,000 crores and the market cap of the entire pharma sector was just 1,31,000 crores. So it's too obvious in retrospect, but then it didn't look. But it was so clear from an extremity point of view. Interestingly, the same sector in 2015, you had a situation where just two pharma stocks, Sun and Lupin, was worth more than the entire metal sector. Just two. I'm not including any of the other companies. Just two pharma stocks became higher than the market cap of the entire metal sector. Again, an example of extremes. And again, over the last 4 years, actually pharma has done very badly because it had become so extreme and the extremity is not identified as easily as by any other single metric called market cap. Now, people ask me, would it work in all cases? I don't think it will work in all cases. Because if I am in a company which is in a completely disruptive technology, like let's say Google, Apple, Facebook, all these kind of things, I don't know whether it will work. But in India, we don't have companies which are at the cutting edge of global innovation or in a scale business of global innovation. So if you attempt it in a company like Apple or Google, I'm sure it will fail. And so you'll have to be very careful. You should not apply it globally, particularly in American tech companies. But if you look at India, clearly metals is cyclical. Clearly you know that pharma is doing certain things, but it is not borderline of everything like a Google or an Apple. So, but similar things happen. Take today. You take HUL. HUL's market cap has again become higher than the market cap of the entire healthcare sector, or at least the top 10 companies. So I believe that it is too easy in these extremes. Nothing negative on HUL. HUL is a great company. It has been a great company for the last 30 years. But the market cap difference helps us as fund managers to take calls for the next 5 years. Will it work in the next 3 months? I don't know. And that is the clear lesson that we learned from this entire experience of using market caps. So I believe, incidentally, Prashant also showed it. If you look at the top 5 stocks by market cap in India, it's today almost double that of the entire PSU universe. And frankly, as most of you know, we have almost all the power in India comes from PSU. When you fill your petrol, almost all the companies come out of PSU. So frankly, the scale difference in market cap at this point of time is very significant. And I think the day the government realizes that they have jewels, and Prashant had almost the same view, I believe the opportunity is phenomenal because the market cap differentials have become almost absurd at this point of time. So I'll say don't use market caps every day, but when you see a trend which has played out very, very significantly, go and look at the market caps. It will work much better in a cyclical country like India. It will work much less in a country like US because you don't know whether Tesla is going to take over auto. That you don't know. And frankly, you will never know. And that's why I would say don't apply it to US tech sector and say that this doesn't work in US tech sector because US tech sector is like what Utpal said, clearly they are all gorillas. So that kind of gorillas, if you have, you shouldn't apply it to the global gorillas, I would call them. So that's clearly the situation. So how to one of the big advantages of the 9 years that I've spent as CIO in ICICI Prudential is that the entire goal of the job is to help people create wealth across asset classes. And there, we have used a very simple framework. So valuations are the easiest part of actually the easiest. Because valuation to judge, there is a number, you can easily get that number, so it becomes very, very easy. But actually, the other three are much more important. What is cycle? Cycle is how other people are handling that asset class. So that is a red signal, the way I look at it. Were there new AIFs being created on large caps in 2017? Certainly not. Were new PMSs getting created on large caps? Certainly not. So you can see the cycle. Cycle is something how your neighbor behaves, how the rest of the community behaves. So if everyone is starting a startup and trying to create a business based on EV to sales, like what happened in Bangalore in e-commerce, that's an evidence of a cycle. So cycle is not how you behave. Cycle is how others behave. And sentiment is actually whether people are putting money in the asset class. Take, for example, credit. We've been shouting that credit is a great asset class, but people don't want to invest. So what happens is that means sentiment is giving you a big green signal. So what is the toughest word in this? The toughest word in this is actually trigger. Because for anything to change, what will happen is there is a trigger required. No one knew why February 1, 2018 was the trigger for underperformance of mid and small caps. No one knew why the real estate market, which was absurdly valued till 2013, stopped. Maybe it was Dr. Raghu's 3% interest rate hike. But nevertheless, on that day, you would never know. Like last year, if you looked at it very closely, there was a big boom in NBFC. You looked at NBFC valuations, it was costly. Cycle, was happening. Every month, some new NBFC was starting with startup money. And you knew that there were so many PEs willing to invest in starting up of NBFC. But the trigger for the NBFC boom to suddenly go away, or HFC boom to go away, was actually ILFS failure. But would I have known that in August 2018, that ILFS will fail and the trigger will happen? No, the answer is no. So I believe that when you have madness in the form of cycle, in the form of sentiment, and you have elevated valuation, you can't wait. You have to act and finish it off. Because trigger is something that you don't know. You think that you will know the trigger. You'll never know. If you go back to the 2008 cycle, 8th March 2009 was a global bottom. Now, if you go back and analyze and look at the newspaper of 8th March 2009, you would have never known why the market bottomed out on 8th March 2009. So I believe that this problem is that trigger is completely uncontrollable. And therefore, you will have to only look at the remaining three. Valuation, which is very easy. Cycle is how others behave. And sentiment is how are flows. So as long as flows are very, very low, valuations are very, very cheap, and people are scared on an asset class, you should just not worry about when the trigger will happen. So in equity, I won't go much more. We are in the middle. But what is unbelievable for us is the fact that over the last many years, we've been publishing this in our monthly fact sheet. And you'll be surprised, it has given you beautiful times to buy, beautiful times to sell. And I'm amazed. And all we make use here is simple techniques: price to earnings, price to book, market cap to GDP, and we do earnings yield. That's all, nothing more. And just that combination of these four, because one of the lessons we learned is that don't use one indicator. So the day you use one indicator, something goes wrong. But you use four indicators and put it composite, you find that it works very well because one indicator can be distorted due to some reason, but 4 indicators can't be. And that's what we learned over this period. We've been publishing it for 10 years. I think if it is so good, I think we'll keep publishing it because it's worked so beautifully for us. And the same question, in 2017, sadly, every month we used to tell people mid-caps and small caps are overvalued. And we tried price to earning, price to book of mid-cap index, small-cap index. Although it showed overvaluation, we couldn't identify a pattern. Much later, we identified data, which is much easier to collect and much easier to actually act on, which is take the market cap of the top 100 stocks, take the market cap of 101 to 250, and market cap of 251 and more. Then the moment you have a very low weightage of small cap, you have to put big money. So if you put money in small caps in 2010, 11, 12, 13, you would have made huge money. You should have taken out money in 2006 and 7 and taken out money in 17. So this data we have started to now publish because it's a very, very simple data. What is that data telling you today? Again, be in the middle. So unfortunately, it will be very nice for us to say we should do this in an aggressive way. But unfortunately, everything is saying we are in the middle. That means neither do we have enough greed, neither do we have enough fear at this point of time. So the same thing we apply to credit. In credit, it becomes too easy. What we do is we take the yield to maturity of one of our funds, pair it with the repo. And we found that signal is telling us put all your money today in credit. Because the valuation signal is fantastic, the cycle is fantastic, sentiment is fantastic. Now what will be the trigger for it to work? I don't know. And if I knew, I would tell you, but I don't know because no one predicted in 2018 ILFS and the one other weak links in NBFC, HFC. It is only after they happened, people realize now this system has changed. And like that, today I won't know when suddenly trigger works. But everything else is in favor, so just ignore the trigger. Now the question that has been asked of me is what do you do with gold and cash? Our reading is very simple there. The moment use gold and cash as a residual asset class. So if credit is costly, debt is costly, equity is costly, which was the situation last year, put money in gold. It worked very well. I mean, maybe a large cap was not extremely overvalued, but nothing was cheap. If nothing is cheap, put money in gold. And if everything is cheap, don't keep any money in gold and cash. So gold and cash can't be analyzed. So I believe that just evaluate it based on what the other asset classes are. And what we've seen is that with these frameworks of valuation, we have found it very, very useful. So people have asked us on real estate. So in real estate, the simple differential is between the home loan rate and rental yield. If you look at commercial has done extremely well in the last 5 years. Why? Because the valuation of commercial was much, much cheaper. The rental yield and home loan rate were almost same in parts of Bangalore 2-3 years back, which is why commercial real estate did very well. So there, the way I look at it is the day that difference between home loan rate and rental yield after accounting for society tax and property tax, it comes to 4%, I think you have to buy real estate. Are we closer to that? Yes, we are closer to that. And when will it come? I don't know. But I think that the simple way of valuing real estate is this gap between home loan rate and rental yield. And you have to take it all on current prices, not on some past price. And I feel that these frameworks clearly help you to prevent big mistakes. So the other thing that we have been focused on, courtesy Howard Marks, is cycles. And what we have seen over a period of time is, and I have now expanded it to say there is one cycle called burst, then there is something called best, then I added something called boring, then there is something called boom, and there's something called bubble. Bubble is the easiest. You have to have a new valuation model. So if you go to 2000, you had .com, what is that, eyeballs, EV to eyeballs. Go to 2007, you had all kinds of EV to a megawatt, EV to land bank, all these new models. They all have to be non-earnings based. So if you go to 2014-15, e-commerce in Bangalore, it was EV to sales. So I believe that in a bubble, you will never have a valuation model which is built on cash flows and earnings. It will be built on top line. And luckily for me as a fund manager, for the last 12 years, we have not had any bubble in equity. Because when you have a bubble in equity and you're saying, I want to be rational, it becomes John Maynard Keynes' statement that the market can be irrational longer than you can have your job. So luckily, what has happened is bubble hasn't happened in equity, but we've had boom. What is the boom? Valuation expensive, money coming in a big way. That happened in 2017 also. Do people make money in booms? If you take out money in a boom, you make it. But if you invest in a boom, you don't make money. You may not lose big money. It's not like bubble, but you will not make money. Boring is something like now. 1 month, everyone is buying. Next month, people are selling. Valuation is not cheap. My assessment in these kind of periods, can you make big money? Answer is no. Can you lose big money? Answer is no. Can you make some money? Maybe. That's possible. So what you need in best time to invest is a period where valuations are cheap and somebody buying is not very big. That is a fantastic time. On the other hand, burst times are just phenomenal. But how do you gather the guts? We discovered that only 2 times anywhere in the world people made mega money is after World Trade Center bombing and Lehman failure. Now in those 2 periods, that means you have a big global negative news, cheap valuations and institutional selling. Now at that point of time, if you have the guts to put money, you'll make huge money. How many people will succeed? 1 out of 100, 2 out of 100. In this room, I'm hoping 10 out of 100. But that is the situation. But I would say that asking yourself, like what Howard Marks says, where are you in the cycle? Whether you're trying to make money or trying to save money. I think it's very important. And every time you ask yourself whether are we in burst situation, best situation, boom, bubble, boring. And I think that will help you to take eventual investment decision in any asset class. Look at it, we may be approaching a burst in real estate. So that's why real estate becomes one of the more interesting asset classes. On the other hand, there is no other asset class where that appears to be the case right now. So that's why that is the kind of situation we are in. So I would say that it's very interesting for you to keep thinking about it. So you have to remember, this is not arithmetic. It's more complicated than arithmetic. There is a judgment involved. And if everything was crystal clear, then and everyone was acting, the opportunity doesn't exist. Because every trade happens because there's a buyer and a seller. That we all know. So I've had my challenges. My biggest challenge has been that if I use trailing PE as a metric, I've been underweight consumer for a very long period of time. So I've been underweight some of the quality stocks for a long period of time. And I believe that each investor will have their own challenges. And in my reading, each investor, if they are aware of their own challenges and they stay with it, I think it's fine. That's why when I say, we have people who are not like that. I have my colleagues who don't worry so much about trailing PE being high because I'm running public money. I'm not running my money. So I need to have all kinds of styles. And over a period of time, each style handled well will work. And this was something which we really found it difficult. And I have always found if everyone is consensus sitting, it's so difficult for me to hold that stock in a big way. And that at times you'll have to, that's why I work with a co-fund manager who doesn't allow me to sell. So because otherwise this consensus sometimes can work. There is no need for consensus not to work. Sometimes consensus will work. And that's where you need to actually work on. And I believe that you will not meet a fund manager who doesn't have a weakness. And the day you think that no one has a weakness, then there is another problem. So I won't go much into this, but I have come to this conclusion that for 99% of people, average ways of investing is good enough. So you do SIPs, you do asset allocation, you do hybrid mutual funds, you do index fund and ETF. Because one of the things that everyone thinks is that everyone can't achieve above average return. So sometimes achieving average return itself is very good. And after watching 2007, 8, 9 as a fund manager, we clearly came to a conclusion that this entire approach of trying to do something average is great for 98% of investors. 2% want to do much above average return, like many people in this room. For that, you have to do a lot of things. But for 98%, simple. Just do SIPs, asset allocation, hybrid investing, index fund, ETF. You're basically done, actually. And will you, over a long period of time, have a good experience? I think so. Because in these models, what you're saying, suddenly you won't wake up in 2007 and say, I want to buy infra. Or in 2017 and say, I want to buy small cap. Or in 2013 and say, I'm going to buy real estate. Remember, all those are barred in this model. Here you're saying you'll do simple things steadily. You'll pursue your other career, whatever it may be. And that's how I look at it at this point of time. Then I would say, no, there are a lot of traits of investing. And the biggest problem that people like me and all have is how to manage my time. And I think I have to learn from Rajiv Thakkar this, because I think the biggest challenge is, and Warren Buffett keeps saying, that if you don't find time to read, then you're not going to succeed as an investor. So I'll say that time to think, time to read, and temperament. And these are the key things that I need to keep improving on. I don't know how people manage, but the more and more you manage your time successfully and find time to read and think, the thinking part is very important. And that is something what I realize many people miss. They find time to read, but they don't think. And believe me, the advantage of our country, sometimes you have long commutes. Even those commute times are superb time to think. Because what happens is that the day you find time to read and time to think, and you have a good temperament, you're going to be a great investor. And that's the simple learning that we have seen. So this is very interesting, and one of the things which worried me a lot is what I call hubris and drunkenness in fund managers. And this is my biggest worry, because what I found was, I think many of you would have heard about this Woodford case this year. He was one of the most celebrated fund managers in UK. And I believe that somewhere what happens is the fund managers are unnecessarily given positive views. And finally it ends they become drunk. They suffer from some hubris and then they make some mistake. So what has worried me a lot is that there is not one. So if you look at it, Woodford, he has been humiliated this year. Anthony Bolton, after being the most successful Fidelity special situation manager, he tried running a China fund and retired. Bill Miller was the most famous value fund manager who basically got demoted. And even in fixed income, Bill Ross was one of the most successful fixed income managers, and he also has kind of retired after failing. So I'm really worried about this aspect. And why does this happen? I think it happens because the entire wealth management community gives as much money. It's this Peter Principle kind of model where they'll keep giving you money till you fail. And what happens is the more successful you are, the more they'll give you money, and the more money they give you, the more they set you up to fail. And that, I think, is one of the challenges which exists in the mutual fund system all over the world. And why does this? The problem is that there's nothing called consistency in performance. Every day, everyone wants consistency in performance. What can I do? I can do consistency in process. And by doing consistency in process, I can deliver huge long-term returns, but not short-term returns. In fact, on a 3-month basis, to succeed is just luck. And you can't predict what will happen. But to create this consistency in performance is not possible. Consistency is process is all that is possible. And if you go tell any customer, I only promise consistency in process, he laughs at you. And that has become one of the biggest challenges. The other thing clearly is that all of us make mistakes. And it is impossible for any fund manager or any investor not to make mistakes. They keep saying there were only 2 people who knew what would happen to the market the next day. One was Harshad Mehta and second was Ketan Parekh, and both went to jail. So frankly, it is not possible to be correct all the time. It is not possible to deliver performance all the time. Is it possible to deliver performance in the long run? Certainly, by using a sensible process. So I asked myself, what all can I do to avoid this hubris drunkenness problem? One was create hybrid funds. Because in hybrid funds, what happens is you are forced to sell as the market goes up. You are forced to buy as the market goes down. That itself forces a situation where you are forced to sell as the market goes up. That reduces your drunkenness. Second is credit. Why is credit interesting in India? Because it is completely illiquid. Every credit decision that you take in India today is based on what Warren Buffett says, hold forever or till maturity in the case of credit. So what happens is it promotes very good decision making because you are never thinking that there is a bigger fool. You're always thinking you have to hold any credit till maturity. So I believe if you think the way you think of credit in India, in equity, you at least don't think I'll find a bigger fool, I'll sell it off. So can I buy 1,000 crores of this stock? All that can't happen because you are thinking that everything is hold forever in equity and hold for till maturity in credit. And I watched who's the person who I think we all have to accept never got drunk. It was Warren Buffett and Charlie Munger. What was the lesson that we learned from them? Actually was be focused on closed-end fund. They run the closed-end fund vehicle. What is the advantage of a closed-end fund? It just doesn't get money. So the market is booming. Like 2007, you still don't get money. In 2008, market is in bad shape, you still have money. So I believe that a closed-end fund and you don't allow leverage, that is a beautiful way to avoid drunkenness and hubris. But I would say that this is the challenge, and I would say we have to be very conscious of this, because if you get more and more money at the top of the cycle, you're setting up yourself up for failure. So what are the other things I really enjoy? I really enjoy the fact that, you are interested in the world. I can assure you, if I had not taken up fund management as a profession, I wouldn't care about Trump impeachment. I would not bother about what is happening in Brexit, what is happening in Greece. Frankly, I believe that as the fund manager job has picked up for me, I am interested in so many things in the world. I'm interested in every election which happens. Everything I have to be interested in. So it has made me very alive to the world. What is the other thing I feel very happy? I watch Charlie Munger. In 90s, he talks like a 40-year-old and with so much clarity. So this is a job that we can do. If we are mentally fit, we can do this job longer. And that is something I really enjoy. And the third thing, very clearly is that you have a situation where I can happily share my theory now. And by sharing theory, Warren Buffett has shared all his theories for long. But still, in 2008 October, there was only one Warren Buffett. Because theory is very easy to share, but practice is much, much more difficult. And I really enjoy that because I can tell people that you be a contrarian. How many people will be a contrarian? Everyone will not be. If Warren Buffett wrote a piece in 2008 saying markets are cheap, and still people didn't buy with him. So because the problem is the gap between theory and practice is driven by one's emotion, and that is the biggest problem. So it's so enjoyable for me that I can share whatever I know about my theories and my ways of investing to everyone. And I'm not worried that someone can copy me. Because finally emotion plays such a big role, or temperament plays such a big role, that I just don't need to worry about it. And when I became a fund manager, for the first 2 years, I used to be super arrogant, thinking that how can this guy make money? Then in 2007, my funds underperformed 15, 16, 17%, three of my funds. That point of time, I went back and introspected. I realized that there are multiple ways of making money. So, as a CIO, I have allowed many of my colleagues to actually run the money they want. The only difference is I told them, you don't come as a fund manager from another place. Because the problem is that I should know how they think, how they work, how they live, what are their approaches to life. But frankly, I believe that there are multiple ways of making money. I have one way, but there are other ways. And other ways can lead the same reason. Recently, I had a TV interview with Ramdev. Ramdev was saying, this is the way to make money. I was saying exactly opposite way to make money. But I think Ramdev is right and I'm right. And in fact, Ramdev said, I agree, for Naren this will work, but for me this won't work. So I think that's the beauty of it, that each of you have your way of making money, and each of you will have to improve your way of making money based on your introspection and thinking. Because how you will work and how I will work will be different. So if you try to copy me without having the same temperament, you'll end up as a big failure. And I think I would say that I don't know how many of you have read Mark Seller's speech. This speech was made in 2005, I think, to Wharton people or MIT people. So it's available on the web. I believe it is one of the best investment speeches I have ever seen. Till that day, again, I used to have this feeling that person with higher IQ would win the investment game. And he gave such a beautiful talk. He said IQ beyond a point is not at all required. And this is something Warren Buffett has been repeatedly saying. But if you had to read a piece every 6 months, I would say you should read this Mark Seller speech. And it's available on the web. And the most interesting thing is that Mark Seller gave this speech in 2005. And the hedge fund he ran in 2008 blew up. So that is the beauty, because he didn't say that I won't fail. He said that if you read his speech, he said there is a certain set of things which are required to be a great fund manager over cycles. He never said I have it. But the most interesting thing is that he was doing something in oil, and in 2008, he failed. And all this is available. I also saw it in the web that he failed in 2008, much later. But I'll say it's one of the best speeches that actually you can get. The other thing is that, frankly, I keep asking myself, can my temperament improve? Can I look more openly at 70 PE stocks? These are questions for which I don't seem to have an answer. But I believe that some amount of learning, some amount of change, you need to do. And if you get caught, then you will get jacked, because time changes. You now have a globalized market. The PE that you are willing to give some company some time back, you shouldn't be giving now, and vice versa. So I believe there is a continuous learning that we all have to do. I am like a public servant. So what happens in this whole process is I'm managing public money. And that puts additional demands on me. So at all points of time, I have to ask myself whether I'm doing the right thing for my investors. And that is one of the, I would say, the toughest part of my job. And SEBI has done a beautiful job by putting my portfolios on the net every month, etc. And I think that the demands of being a public money manager is much, much higher than the demands on any of you on your individual monies. And if you don't enjoy the job of managing public money, then it's very tough. But I think for me, it's been 15 years and I've enjoyed it. So that is the thing. But market irrationality is part of the stress of this job. I always hope that irrationality stays for about 12 months and not for 36 months. Because I think if it stays for 36 months, job is gone. So it's very important that irrationality stays and then goes away, goes away. So I would ideally want to have irrationalities lasting about 12 months. But just because I want it to last 12 months doesn't mean that the irrationalities will stay for 12 months. In 90s, by the way, it stayed for 36 months. And so many people lost their jobs. So otherwise, I'm not going to talk much. I've also had my time. I think most of you know that these are some of the best people to track: Howard Marks, James Montier, Atul Gawande, and Michael Mauboussin. I'll only say that what Michael Mauboussin taught is something called pre-mortem to me. And I'll say that very often we do this pre-mortem, because the day you do post-mortem in my company, it is who has made the mistake. The advantage with the pre-mortem is that you're not assessing who has made the mistake. You're assessing what can happen. And based on the mistakes committed in the 2009 election, we took a set of pre-mortem decisions in 2013 by launching Value Series 1, which was one of our best decisions. So I believe what I learned from Michael Mauboussin is pre-mortem. Can I improve my checklist, which Atul Gawande said? Yes. Can I improve the implementation quality of my checklist? Answer is yes. Unfortunately, it's still work in progress to some extent. And what you learned from Mondier is clearly contrarianism. And I think the 10 tenets of investing piece that he has written is one of the best pieces ever. So with that, I stop. Thank you all.